You've been a part of some big battles, some big losses, some big wins. It's been a roller coaster. So in terms of temperament, psychologically, how do you not let that break you? How do you maintain a calm demeanor and avoid running with the lemmings?
I think it's something you kind of learn over time. A key success factor is you want to have enough money in the bank that you're going to survive, regardless of what's going on with volatility in markets. People who, one, you shouldn't borrow money. So if you borrow money, you own stocks on margin, markets are going down, and you have your livelihood at risk, it's very difficult to be rational. So key is getting yourself to a place where you're financially secure. You're not going to lose your house, right? That's a kind of a key thing. And then also doing your homework. Stocks can trade at any price in the short term. And if you know what a business is worth and you understand the management, you know it extremely well, it's not nearly as, it doesn't bother you when a stock price goes down, or it has much less impact on you because again, as Mr. Graham said, the short term, the market's a voting machine. You have a bunch of lemmings voting one direction. That's concerning. But if it's a great business, doesn't have a lot of debt, and people are going to just listen to more music next year than this year, you're going to do well. So it's some combination of being personally secure and also just knowing what you own. And over time, you build calluses, I would say.
So psychologically, just as a human being, speaking of lions and gazelles and all this kind of stuff, is it as simple as just being financially secure? Is there some just human qualities that you have to be born with / develop?
I think so. I think, now I'm a pretty emotional person, I would say, or I feel pretty strong emotions, but not in investing. I'm remarkably immune to kind of volatility. And that's a big advantage. And it took some time for me to develop that.
So you weren't born with that, you think?
No.
So being emotional, you want to respond to volatility.
Yeah. And it's a bit, again, you can learn a lot from other people's experience. It's one of the few businesses where you can learn an enormous amount by reading about other periods in history, following Buffett's career, the mistakes he made. If you're investing a lot of capital, every one of your mistakes is going to be big, right? So we've made big mistakes. The good news is that the vast majority of things we've done have worked out really well. And so that also gives you, confidence over time. But because we make very few investments, we own 8 things today, or 7 companies of that matter. If we get one wrong, it's going to be big news. And so the other nature of our business you have to be comfortable with is a lot of public scrutiny, a lot of public criticism, and that requires some experience. Call it that.
I think we'll talk about some of that.
Yeah.
Financially secure is something you, I believe, also recommend for even just everyday investors. Is there some general advice from the things you've been talking about that applies to everyday investors?
Sure. So never invest money you can't afford to lose. Where it would, if you lost this money and you lose your house, etc. So being in a place where you're investing money that you don't care about the price in the short term. It's money for your retirement, and you take a really long-term view. I think that's key. Never investing where you borrow money against your securities. The markets offer you the opportunity to leverage your investment. And in most worlds, you'll be okay. Except if, there's a financial crisis, or, a nuclear device gets detonated, God forbid, somewhere in the world. Or there's an unexpected war, or, someone kills a leader unexpectedly. Things happen that can change the course of history, and markets react very negatively to those kinds of events. And you can own the greatest business in the world, trading for $100 a share, and next moment it could be 50. So as long as you don't borrow against securities, you own really high quality businesses, and it's not money that you need in the short term, then you can actually be thoughtful about it. And that is a huge advantage. The vast majority of investors, it seems, tend to be the ones that panic in the downturns, get over elated and when markets are doing well.
So be able to think long term and be sufficiently financially secure such that you can afford to think long term.
Yeah, Buffett is the ultimate long-term thinker, and just the decisions he makes, the consistency of the decisions he's made over time, and fitting into that sort of long-term framework is a very, very educational. Let's put it that way for learning about this business.
So you mentioned 8 companies, but what do you think about mutual funds that are for everyday investors that diversify across a larger number of companies?
I think there are very few mutual funds. There are thousands and thousands of mutual funds. There are very few that earn their keep in terms of the fees they charge. They tend to be too diversified, and too short term, and you're often much better off just buying an index fund. And many of them perform. They look. If you look carefully at their portfolios, they're not so different from the underlying index itself, and you tend to pay a much higher fee. Now, all of that being said, there's some very talented mutual fund managers. A guy named Will Danoff at Fidelity's had a great record over a long period of time. The famous Peter Lynch, Ron Barron, another great long-term growth stock investor. So there's some great mutual funds, but I put them in the handful versus the thousands. And if you're in, the thousands, I'd rather someone bought just an index fund, basically.
Yeah, index funds. But what would be the leap for an everyday investor to go to investing in a small number of companies, like 2, 3, 4, 5 companies?
I even recommend for individual investors to invest in, a dozen companies. You don't get that much more benefit of diversification going from a dozen to 25 or even 50. Most of the benefits of diversification come in the first, call it 10 or 12. And if you're investing in businesses that don't have a lot of debt, they're businesses that you can understand yourself. You understand, actually individual investors did a much better job analyzing Tesla than the so-called professional investors or analysts, the vast majority of them. So if it's a business you understand, if you bought a Tesla, you understand the product and its appeal to consumers. It's a good place to start when you're analyzing a company. So I would invest in things you can understand. That's kind of a key. You like Chipotle, you understand why they're successful. You can go there every week and you can monitor. Is anything changing? How these new how's chicken al pastor? Is that a good upgrade from the basic chicken? The drink offerings improving. The store is clean. I think you should invest in companies you really understand. Simple businesses where you can predict with a high degree of confidence what it's going to look like over time. And if you do that in a not particularly concentrated fashion and you don't borrow money against your securities, you'll probably do much better than your typical mutual fund.
Yeah, it's interesting. Consumers that love a thing are actually good analysts of that thing, or I guess a good starting point.
And by the way, there's much more information available today. When I was first investing, literally we had people faxing us documents from the SEC filings in Washington, D.C. Now everything's available online. Conference call transcripts are free. You have AI. You have unlimited data and all kinds of message boards and Reddit forums and things where people are sharing advice. And everyone has their own, by virtue of their career or experience, they'll know about an industry or a business, and that gives them. I would take advantage of your own competitive advantages.
I'm just afraid if I invest in Chipotle, I'll be like analyzing every little change of menu from a financial perspective and just be very critical.
If it's going to affect your experience, I wouldn't buy the stock.
Yeah, I mean, I should also say that I am somebody that emotionally does respond to volatility, which is why I've never bought index funds, and I just noticed myself psychologically being affected by the ups and downs of the market. And I want to tune out because if I'm at all tuned in, it has a negative impact on my life.
Yeah, that's really important.